KPMG chief economist Diane Swonk. Diane, social media is awash with theories of an economic bubble that's just about ready to burst. To what do you attribute today's rally on Wall Street?
It really is hard. There is a bubble. Things look frothy. That said, this is not just an AI boom in terms of data centers going up everywhere and building out the infrastructure for AI. It is also an AI arms race with China. And I think when you look at it that way, you see why the market continues to go because they see that the US government has a vested interest in this. Doing it right and getting it done. Now, those are hard things to execute on, and I am concerned that in an economy where 10% of households are accounting for nearly half of all consumer spending, if anything were to rattle financial markets and this rally that we've seen, that would slow down the economy pretty dramatically. But it also speaks just to the inequality and how the stock market is not the economy. And in fact, the economy is not feeling as good as it looks on paper, at least in the third quarter, to the overwhelming majority of Americans, in part because of their concerns about both the job market and inflation, which are two things you don't usually see rise in tandem in concerns. And that is sort of the stagflationary nature of tariffs.
We heard Elizabeth mention there that inflation came in lower than expected, but still relatively high at 3% year over year. What were the biggest surprises in this report?
Well, I think one of the biggest surprises is, first of all, how much of the report was imputed because of staffing shortages. They had to close a lot of regional offices. This is since the beginning of the year. This is not to do with the shutdown. 40% of all the prices in the consumer price index were imputed. And that means they looked at things that were similar, not exactly the same, or they used history as their guide. That may not be reflecting in real time the actual changes we're seeing in inflation. So that 40% number really high for the year, the highest number we've seen all year. That is something that I really sort of am worried about. Are we getting the full picture? The other thing that was really interesting is what was not related to tariffs, but really spiked because of shortages of workers, and that was in the care economy. Elder care went up at its fastest pace for one single month on record. That is where immigration plays an outsized role in filling those jobs in home elder care. And that surge was not expected, but it is in response to a loss in workers. And in fact, it's one of the things we've seen is the supply of workers has dried up, even as demand for workers has come down. And that's not why we have not seen a larger increase in the unemployment rates thus far. Another place that's really hitting households is childcare. Childcare went up at its third fastest pace on record. Again, high quotient of immigrant labor in that market. And one of the problems that we're starting to see is that families are having to make difficult choices about the hours they work because they don't have childcare or access to childcare anymore. Some childcare shelters have basically closed down entirely, and that's pushing a lot of women out of the labor force with children under 5 years of age. On the elder care side of it, we've got a lot of young people that are pretty evenly split between men and women caring for elder people in their home. And in fact, in the youngest categories from 15 all up to over 30, it's men.